Hi there everyone, it is Monday the 23rd of October and that means it's time to take a look at what moved the markets last week. Beginning with two of the major US indices, just so that we get an overview of the kind of price action we saw in the market. We can see that in the NASDAQ 100, that's the chart at the top, and the SP500, there was quite a dramatic fall. And from 2 Fridays ago until Friday last, each of those indices fell 2.9% and 2.3% respectively. There are several things that caused the decline through the past week, a variety of things in fact. One of them was the increase in the price of oil. It wasn't so dramatic, but it has been a byproduct of the conflict in Israel, which has escalated significantly through the past few days. Last week we also heard from Jerome Powell, the Federal Reserve Chair, and he said that although the bond market does seem to be doing some of the Fed's job for it, the US economy is still very, very strong and it might need more help being restrained. In response to this, we saw yields on bonds in the US, government bonds in the US, rise once again, and the yield on the US 10-year bond rose above 5% for the first time in a very, 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 very long time. You can see these little dots, maybe you can't see them, but these little dots going all the way back to 2007. That was the last time that yields on the 10-year bond were this high. So you can see that through the last week, the yield on the US 10-year government bond rose by 6.68%. Most stocks react negatively to chunky movements in yields, and that's because almost all companies need to take on some form of debt to grow. When yields rise, the companies that are impacted the most tend to be high growth companies because they're usually the ones that are capital hungry. They need lots of money to drive that growth. And proportionately speaking, they tend to take on a fair deal more debt than other types of businesses. So in addition to the conflict in Israel, the price of oil, and a hawkish-ish Fed, we also got some macro data out of the US that was a little bit worrying. So the Fed was responding in part to the retail sales numbers that we got out of the US. These come in a lot stronger than had been expected. So the consumer in the US is still spending a lot of money. And we can see on Thursday that the initial jobless claims number came in a lot lower than expected. So the labor market is strong and the consumer is spending. One of the few bright points within the macro data last week was that China's GDP came in quite a lot stronger than had been expected at nearly 5%. And this points to quite a strong contradiction in the performance of China's economy and the performance of China's stock market. So I'm not sure which one of the major indices, I saw the headline earlier today, but it had touched the pandemic lows. And yes, China still had a lot of work to do to deal with the financial crisis that was created by its real estate market, as well as those lockdowns. They are a country that still has a growing economy and an economy that's growing quite strongly. But when it comes to investing in the stock market, sentiment tends to win out in the short term. So even though the economy in China is powering up, investors are still scared to own Chinese assets. Last week, we also saw some very interesting earnings reports. So the first of these being a company that we own, Taiwan Semiconductor. I do have a small position in the company just because they are politically quite risky. And semiconductors tend to have a tough time when you're in the trough of the economic cycle. Despite the global economic challenges, TSM delivered incredible earnings. And on top of this, their forecasts are still quite strong. Although given what's going on in the world, I think that it's going to be very difficult for any company to accurately predict where they're going to be a few quarters out from now. Another earnings report that was very well received was Netflix, who now have a record number of paid subscribers. You can see the strength of growth in the subscriber numbers through the last quarter. I did sell out of my Netflix stock a few months ago because I believe that a lot of the growth had already been built into the stock price. I'm still very happy that they managed to beat and by such a large margin. However, Netflix is a company that sells one thing, which is streaming TV. There's a natural saturation point that they're going to hit, and there aren't many other things that they can sell around it. They're trying to get into the gaming industry that hasn't worked very well so far. If they do manage to break into that industry, I think that would be a huge driver of potential future growth. But it does feel as, for now, they're approaching a saturation point. That doesn't mean that growth will necessarily stop, but I think that they will have a tough time growing nearly as quickly as they did through the 2 decades before that. We also heard from Tesla. I didn't do a deep dive on the earnings report, although at this point I think that most people know that they didn't fare very well through the past quarter. Elon Musk continues to say that high rates will be a challenge for his business, and that the longer they stay high, the more impacted his company will be, which of course is a natural consequence of people having to borrow money to buy cars. Cars are a fairly large purchase, and high rates mean that they are less likely to take out those loans. Outside of stock news, and something that I am just personally very interested in, is solid state batteries. The short version of why this is so important is the world is transitioning to greener energy. However, transitioning isn't enough. We also need to be able to store the energy that is being captured. The reason for this is you don't necessarily have peak utilization of energy at the times when you have peak generation of that energy. This is fairly obvious for the likes of energy that's generated through solar power or wind power. The problem is that storage solutions are very expensive to buy, they're very expensive to maintain, they don't necessarily last for very long, and sometimes it's very slow to get energy into them. Toyota has been working with several different companies to work on a new kind of battery, something called a solid state battery. One of the other advantages of solid state batteries is they tend to use materials that are a lot more abundant than the batteries that we use today. As an example, some solid state battery technologies use iron, but like any new technology, developing that technology initially is very, very expensive. There are lots of kinks to work out of the technology, lots of problems to overcome. But now it looks as though Toyota is getting much, much closer. So if they're successful, I've just highlighted this one paragraph, it expects cars powered by solid state batteries to have a much bigger range than they have today, 1,200 kilometers, and a charging time of 10 minutes or less. Toyota is now saying it's solved enough of these problems to have a path to making solid state batteries en masse by 2027 or 2028. And if they are successful, you can imagine that Toyota is going to make a shit ton of money. This is very exciting, not only from an investor's perspective, but because it would change the dynamic when it comes to electric vehicles. If you can charge these cars in 10 minutes or less, that means that you can get rid of a lot more internal combustion engine cars that are already on the road. All right, so what about this week? Well, since we're on the topic of earnings, this week is going to be a huge week. We're seeing Google, Microsoft, Visa, Meta/Facebook, MasterCard, VW, Overstock, Amazon, all reporting earnings through this week. On top of that, we've also got some big macro data hitting the wire. The GDP number out of the US will be closely watched. It's forecast at 4.2%, quite a whopper when it comes to growth. Initial jobless claims will also be watched, but the most followed piece of data hitting the market will be on Friday, and it'll be these core PCE numbers, core PCE being the Fed's preferred measure of inflation. I know it's painful when you see stock prices declining, but this is a natural part of the stock market's rhythm. It also means that there are opportunities being created. I've been picking up more bond ETFs as yields have risen, and through the next 2 weeks I will be reallocating some of my funds. There are lots of great opportunities out there. For example, SolarEdge reported earnings. They were awful, but they also pulled down just about every other solar company out there, including those companies that are likely to be the leaders through the next decade. All right, speak to you soon. Goodbye.